Hey guys, Toby Mathis here, and today we're going to go over 10 tax strategies that the rich use, and maybe you should too, right? Let's dive in. Number one, and I'm just going to kind of paint this broadly. I'm a tax attorney, so I'm going to say that the rich really do understand tax planning, and they don't understand tax planning in the terms of, I'm going to find every loophole known to man, is that they understand that there's not a lot to fear from the tax code and things. Tax code is absolutely stacked with gold nuggets and incentives that are there for you to use. For example, I'm going to go over investments where you don't have to pay tax on. Why? Because they need to incentivize certain investments into certain areas. I'm going to go over different things where you do get tax breaks. And why? Because they incentivize certain behavior, certain types of activity. The rich understand this and they're not afraid because they also understand the numbers. So, for example, there's a what's called the Transactional Records Access Clearinghouse, the track system at Syracuse University. They actually had to sue and get a court order under the Freedom of Information Act to get the information from the Treasury. But what they found is that the poor really are audited significantly more than the rest of us. But overall, it's about 4.1 audits per 1,000, which is less than 0.5%, which is just crazy. The poor, if you have that earned income tax credit, for example, 12.3 audits per 1,000, significantly higher than that 4.1. And everyone else, when you remove the poor, is at 2.3 audits per 1,000 returns, like less than 0.25%. So are you scared? I have less than 0.25% of being audited. And what's more importantly is we don't worry about audits. You don't see them very much if you know what you're doing. Like, again, a taxpayer who's making $200,000, very, very unlikely. Like less than, it's right around one out of every 1,000. It's just a fraction of a percent. You get over 1 million, you might start seeing it creep up a little bit. But again, there's only just over 7,000 audits of millionaires in the United States last year. And that's down from 40,000 about 15, 20 years ago. Like, it's really gone down. So there's not a lot to fear. Why not? Because we have enough information now at our fingertips. We can make sure we're doing everything correctly. Gone are the days where you went to the accountant and hoped that they read in a book a tax strategy. Now, between AI and Google and YouTube, like spend some time on my channel, you're going to learn all the different legal techniques to lower your taxes. And that's what the rich do. So let's dive in. We got 10 of these suckers. Let's go in number one. So I'm going to write these down. Number one is retirement savings. Whoop. I'm just going to call it retirement accounts. Did I screw that up? Yeah, I probably did, but whatever. Retirement contributions. So this is where the rich understand that I can get a tax deduction if I contribute into certain types of plans. Now, I'm not just talking about plain vanilla IRA and 401k, and you're like, okay, that's great. That's going to get me tens of thousands of dollars. No, the rich understand that there's actually plans where they can put substantially more. And what type of retirement plans are we talking about? Defined benefit plans. Clients are putting $500,000 plus into some of these plans. And what you're doing there is you're hiring an actuary who's licensed with the IRS to actually do a study and say, hey, if you're used to making $250,000 a year, how much retirement money do you need to have so that you can continue to make that same $250,000 a year when you retire? Well, guess what? It's going to be like $3.5, $4 million is going to have to be in your retirement plan. What if you only have 10 years to do it? Oh, wow. I could put in $300,000 a year? Yes, even more. It all depends on your scenario, how much you're making, how old you are, and what type of returns you're getting. So the rich understand that these vehicles are out there and are available to be used. And I would suggest that you learn about a few of them and make sure that you're using them to your advantage too. And again, there's different categories. A lot of us are used to the individual, what's called an individual retirement account or arrangement. I think an IRA, individual retirement arrangement, is actually what it means. And we're not so well versed on the business side of it. It's like the 401ks, solo 401ks, defined benefit plans, those types of things. And I would encourage you to work with somebody who actually understands those things and to get familiar with them because there are huge benefits. Yes, I could be making in a side hustle $20,000 a year, then it flows onto my taxes and I'm paying 30%. I'm losing $6,000 a year. It's draining away. But what if I put that entire $20,000 into a tax deferred account? Not only am I saving the $6,000, but my growth will be tax deferred. And eventually, if I'm taking the money out, there's a way to avoid the tax even on that in retirement if you understand taxes. And again, I'm not going to dive into all the strategies. I'm just going to say short-term rental, real estate professional, donations, using a 501c3. There's all vehicles so that you don't have to pay tax on it. But there's ways to get that money out tax-free. But the rich understand retirement accounts. They also understand taking advantage of tax deferral. And what do I mean by tax deferred investments? I'm going to use the example that we're all pretty used to. Let's say that I invest in Microsoft. And I was one of the first ones to invest in Microsoft. And Microsoft's gone up and it's split and doubled and tripled and quadrupled, whatever. Like my investment's gone up huge. Or better yet, I'm going to talk to you millennials out there. Let's say you bought Bitcoin and you bought Bitcoin at $1,000. Okay, it's now worth what, 70,000? Did you pay tax on the 69,000 it's gone up? No, that's because it's tax deferred until I do something to it. So I either sell my Microsoft shares or I sell my Bitcoin. That's when it's taxable. The rich understand that there is a strategy to access the capital without incurring the tax. And here's how. Borrow against it. So if you have a bunch of Microsoft stock, for example, and you have it in a regular brokerage account, you can get what's called a security-backed line of credit, which means the brokerage house will loan you money against those stocks as security, and loan proceeds are not taxable. So there used to be an old adage in the, like for rich people, they'd say, buy, borrow, die. And why would they do it in that order? Because when you buy something, well, depending if it's real estate, I could actually get a tax deduction. I could get the depreciation. If it's stocks, I'm probably not. But I'm still, if I'm like buying early enough, maybe I'm buying super cheap and I'm planting a bunch of seeds and some startups. One of them takes off. Then I borrow against it. Think of Elon Musk borrowing against his Tesla shares. And then when I die, there's something called a step up in basis, which means I don't have to pay tax, or better yet, my heirs don't have to pay tax on any of that gain. It's actually gone. My basis steps up. So if I have $10 million of Microsoft that I paid $400,000 for, better yet, let's just say I spent almost nothing. Let's say I spent $10,000 and now it's worth $10 million, whatever the stock might be. I've been sitting on it my whole life. For 50, 60 years, I've been sitting on that stock. And I pass away. My new basis is not the whatever I paid for it, the 10,000. My new basis is the 10 million. Yeah, and I'm not joking about that. You pay zero tax, like your heirs will pay zero tax. So the rich understand this and make sure that they are investing in tax deferred. So it's, again, I can borrow against those assets during my lifetime, and maybe I pay it back, maybe I don't. I pass. No tax when I sell it. I can pay that loan off, and I paid zero tax on any of that gain. None, nada, zero. Rich understand this. You should too. Number 3, they understand something called loss harvesting. This is something that President Trump taught us all about at a national level when they're looking at it going, how did he not pay taxes? First off, they shouldn't have kicked his returns out there. That was a breach by an IRS employee who ended up going to jail. But there's they did it to a whole bunch of folks. They did it to Elon Musk, Warren Buffett, a bunch of others. But that President Trump, what he showed us was, whoa, there's these huge tax incentives in real estate, and we're able to harvest a lot of those losses. There's another way to harvest losses, which is when you have, let's say it's Bitcoin again, and it goes down. I bought Bitcoin at 60, and I thought it was going up to 100, and it dropped to 30. I could literally sell that, harvest the loss. There's a $30,000 loss. I bought it at 60, I sold it at 30, but I immediately buy it back at 30. And as of the recording date here, there's nothing wrong with that. I could actually do that. There's no wash sale loss rule. There is a wash sale loss rule on stocks that say you got to wait 30 days to buy it back. There's a workaround on that as well. The rich know this. You can harvest the loss on just about anything. I can harvest the loss by selling it, recognizing a loss if I have a down market or I'm down on something. And I can use those losses against my other gains. An example, I have Microsoft and I'm up $100,000. I'm going to sell it and I want to sell it and exit my Microsoft position. I'm going to have $100,000 worth of gain. On the same token, I have a bunch of crypto that has fluctuated and it's at a down point, and I have $100,000 of unrealized loss. So I could just go ahead and sell that crypto, realize the $100,000 loss, buy it right back, and use that loss to offset my $100,000 of gain. Now, I could do this on a continuous basis as well. In fact, there are funds available to people, private investment funds, where they target loss harvesting to offset your other gain, and you still get market returns, but they are very, very good about exiting positions when they are experiencing a short-term downward trend, which happens in the market all the time. The market's always doing this. If you get used to, hey, let's harvest some loss, re-enter the marketplace, ride that back up, I still get to grab that loss. Then it goes down at some point in the future, I could do it again, right? So I am using my losses against my gains. There's other things you could do that for in passive, for example, in passive investing. In real estate, I might go ahead and create loss like President Trump did, where he was able to accelerate and bonus a bunch of depreciation. He was able to carry it back 5 years under some Obama era tax rules and offset a bunch of taxes he'd already paid. We had the same thing during the CARES Act, during COVID, where we were able to carry back some loss and we're getting tax dollars back. So I'm just going to call that loss harvesting. Some of you guys that are accountants out there are losing your minds already. Trust me, on crypto, it's not wash, sale, loss rule. Even on stocks, there's a workaround. It's buying an in-the-money option to secure that position and then buying the shares back and then selling the option later. You can actually do that, and the loss attaches to that option. But I have videos on that one too. But loss harvesting. Now, I mentioned 4 already, but it's a huge one, and that is real estate. And here's what's important. In real estate, if I buy land, I don't get big, huge tax benefits. If I buy land, I don't get to write anything off other than maybe the property taxes and some insurance. But if I buy real estate with something on it, I buy a rental property, a duplex, a multifamily, a commercial, a warehouse, a self-storage, mobile home park, like if I buy the park with the pads and stuff like that, that real estate, those improvements can be depreciated, and depreciation equals deduction. Now, here's where the rich and the poor really separate themselves. A lot of folks are under the impression that you write off real estate over 27 and a half years if it's residential, 39 years if it's non-residential. That is a good starting point, and that's kind of a default that people use, but it's actually not a permissible method. You're not supposed to be doing that. What you're supposed to be doing is taking the components of your real estate and breaking them down into their useful lives. So the IRS will let you, for example, write off a single family home over 27 and a half years, but you could break it into its 5-year components like the carpeting and removable flooring, stuff like that. The appliances, some of the cabinets, some of the plumbing and things like that brought into an appliance. Like think about having a washing machine or a dishwasher, things like that. The platform for it, the cement that it's sitting on, the plumbing that was brought there, the electrical that was brought there, anything that's attached to an appliance technically takes its lifespan. So all that plumbing and all that electric is actually 5-year property. I go and I look at a fence, I look at a driveway, those are land improvements, that's 15-year property. Window treatments, all these things have lower lifetimes than 27 and a half years, and you can write them off much quicker. And there's quite often something called bonus depreciation, which means I don't even write it off over 5 years. I might get to write it off immediately. Sometimes it's 100%. It all depends. Every year it's fluctuating around. Congress is talking about making 100% right now. As I'm standing here today at 60%. But I get to write things off much, much faster. And I get to create loss. And if I create loss, then I can use that to offset my other tax. So if I'm a doctor, for example, and I'm making $500,000, and I can create a real estate loss that I can use against that income, it's worth a lot of money to me. Let's say I make a $100,000 loss, that's worth 37% or 35%, depending on what bracket I'm sitting in. I get a big benefit by using those losses. I have some hoops to jump through. I might have to be a real estate professional. So either myself or my spouse is going to have to qualify. I'm going to have to materially participate, or I could do short-term rentals, or I could invest in things that create ordinary loss, like oil and gas and stuff like that. I could be investing in those types of projects. But there's really not much better from a tax standpoint than real estate. Literally, I could be making money every year and not having to pay tax on it. So if I have a single family home and it's making net $1,000 a month, but it's depreciated, so that in my bank account I have $1,000 positive cash coming in every month, but from a tax standpoint I have a zero because I'm using the building, the deduction for the depreciation against the income, and it offsets. Then I pay zero tax on that. So I have $12,000 a year coming in with no tax. That is a very effective. Now, add some zeros to that, and that's what the rich people are doing, right? So it's always kind of fun when you start digging into these. And so I always say, like, good, better. Good is, hey, plain old vanilla depreciation is really good. Better is cost seg the property, start writing things off a little bit faster. Best, real estate professional or short-term rental, where you can write off those losses as ordinary. And then the insane strategy with real estate is I could sell it, do what's called a 1031. And don't worry, I have 1031 videos if you want to learn about that. If I sell real estate and buy more real estate, and it doesn't have to be 1-to-1, it could be I sell 1 and buy 10, I sell 10 and buy 1. As long as I'm buying real estate and I'm following the rules, which is a 1031 exchange, it's under 1031 of the tax code, I'm using a qualified intermediary, I don't have to pay tax on any of that gain or recapture on the depreciation. All I have to do is 1031 my real estate throughout my lifetime and then eventually pass away. Because remember that step up in basis? It works on real estate too. So again, I could be buying real estate my entire life. It could be going up in value. I borrow against it, spend that money on more real estate or going on vacations or whatnot. All I have to do is eventually pass away, and voila, zero tax. Rich people understand that. You should too. All right, number 5, charities. 501c3s, big old deduction. You can write off up to 60% of your adjusted gross income by writing a check to a charity. Why not your charity? Why not using charities in your life? There's a lot of things that you could do with the charity that people don't realize. And I use the example of IKEA. It's a charity. Rolex, owned by a charity. Hershey's, mostly Milton Hershey Foundation. Right? These things are worth billions of dollars. Harvard, charity. These are all exempt organizations that don't pay tax. NFL was a charity, now, and they made it private. Major League Baseball, still a charity. NHL, still a charity, right? There's lots of things that you could do that are charitable activities. For example, in your real estate, if you want to write off a house twice, here's how you do it. You buy a rental property, you depreciate it over its useful lifetime, 27 and a half years go by, and you're like, shoot, I've depreciated the heck out of it, but it's worth a lot. Give it to your charity that's for low to moderate income housing, or maybe you make it into veterans housing, single moms, recovery housing, whatever. You make it into something that is a charitable activity. And by the way, low to moderate income housing is a charitable activity. There's a safe harbor for it. So if you're doing HUD housing, for example, and you're just saying, hey, I want to take care of a specific group, my elders, again, veterans, moms, whatever, fill in the blank, I could make it into a charitable activity. Now, when I give that house, the fair market value of that house is a charitable donation. I'm not kidding you. You could literally write off a house twice. So I buy a single family house, 20 years, I depreciated most of it. I bought it for, let's say it's one of my houses, and I'll give you a real life example. I paid $90,000 for a house in Florida. When I donated it, its value was $315,000. What was my tax deduction that year? $315,000. I was in the highest tax bracket. My tax savings was over $120,000. I only paid $90,000 for the thing. My tax savings were more than the house was worth. That's using charities. So that you could do things like that. You could use something like a charitable remainder trust, where your charity is the end beneficiary, so that if I sell something, I can avoid tax and I could spread that tax over many years. Maybe you're doing a charitable remainder unit trust and you're going to spread that income out over 20 years. Great. Rich people understand this. They understand that there's real rules, and if they follow it, they'll be able to do it. Now, there's huge advantages to doing it. So I'm going to say again, there's kind of good. Hey, just make a charitable donation every year. That's good. Give it to your church, give it to a charity, just be a good person. I actually say you should give 10% of your income away every year. I'm one of those weird people, right? I'm not going to tell you to tithe to your church. I'm just going to say do something good with it. Most of my successful clients give. Like the vast majority of wealthy people give. Why do they give? Because it's good. It makes you feel better, and because you get a charitable deduction. Better, use a donor advised fund, and instead of giving $5,000 every year, give $20,000 every 4 years. Put it in a donor advised fund and then use it to give the money to the actual charity. Why do you do that? Because most of us miss out on our charitable donations because the standard deduction that we get on is better. So our standard deduction is so high right now, 14,000, 28,000 if you're married, that you don't get to write off and you get no benefit for your charitable donations. So instead, give, we call it getting lumpy, give larger amounts more seldom, but use a donor advised fund. A donor advised fund is a fancy way of saying an investment account that gives to charity, but you get the charitable deduction when you fund that account. And then you could still trade in it, you could still invest in it, and then you use that to give money to your organization. Best, hey, own your own charity, set up your own 501c3 and do that. And then the insane one is when you start using CRUTs and CRATs and these other vehicles. But realistically, just getting your taste buds accustomed to the idea that charities aren't what you think. You could be working for your charity, your family could be working, your family could be a board. There's lots of different versions. A lot of people think of family foundations and they have to give money away every year, 5%. Yeah, but there's other versions where you don't have to do that. And especially if you're willing to do something, feed, help, educate, amateur sports, all those are charitable activities and you don't have to give away money. Now, that takes us into our sixth one, which is trusts. And no, I'm not going to sit here and tell you trusts don't have to pay taxes. That's nuts. I've done whole videos on the scams that are out there teaching this nonsense. No, what trusts are really good at is if I use an irrevocable trust in my estate planning, then I can get some tax benefit by avoiding the estate tax on transfers if my estate gets too big. If I want to freeze the value of something, I can make a sale to a irrevocable trust with a third-party trustee, and I'm following the rules, and I could avoid nasty estate tax, which is about 40% on amounts. Right now, I think we're over, what is it? It's more than $10 million a year. I think it's like 13 million for an individual, double that up, 28 million or something like that for married couples. Like it's a huge amount, but it's scheduled to go back down to its pre-2017 levels. The Tax Cut and Jobs Act jacked it way up. Before that, it was $5 million per spouse, and it's going to go back down to that, adjusted for inflation. So my guess is probably $7 million per spouse. So if your estate's over 14 million, anything over that, it's going to be 40%. It's a pretty big hit. And so these trusts allow us to lock in certain benefits during our lifetime. We could also use trusts in the form of charitable remainder trusts, charitable remainder annuity trusts, and other things where we can get benefit as well. But the rich understand that these vehicles exist, and they talk to people and say, when would it be helpful? There's spousal lifetime access trusts, there's SLATs, there's all these things, GRATs, grantor retained annuity trusts. There's all sorts of vehicles that the rich understand how to use, and you just need to know that they're out there and start asking the question. As you start building up your wealth, you want to be cognizant of it. Now, the most obvious trust that's going to save everybody money, period. It's almost impossible not to save money if you have any assets at all with a living trust. And they're very simple to set up. They're freely revocable during your lifetime, but what it's going to do is it's going to keep you out of court and your family from fighting by keeping out of court when you pass away. And there's other benefits to it. We used to use AB provisions, Q-tip provisions, all sorts of things to keep your assets together, to make sure you don't disinherit your kids accidentally, all sorts of other benefits. Rich understand that these things are out there, and they talk to people who are experts in those areas to make sure that they're using them where appropriately. Number 7, they understand the power of businesses. They own businesses. Almost all the wealthy people I know have some sort of structure. It's either a family office, it's a management corporation, it's a series of LLCs that hold real estate assets, safe assets. They're keeping it out of their name. They're taking the bullseye off themselves, and they're making sure that they do not lose their money simply by something that could unfortunately happen. Like maybe a kid gets into a car accident and they severely harm somebody. I'll give you a real life situation. My partner's friends, their child went to Arizona University of Arizona, and hit somebody in a crosswalk. They didn't mean to, but that individual turned into a quadriplegic and sued the lights out of them. The parents had to go bankrupt because they're still responsible for their child, right? The rich understand that businesses can shield from that. But the rich also understand that businesses provide major tax breaks. For example, if I am engaging in some sort of activity as an individual, and a lot of times people think of these like they're borderline hobbies. Hey, but I have a profit motive, but I really enjoy doing it. The rich understand that that could be a major tax break, and they're not scared. They're not worried about Hobby Lobby rules and these types of things because they understand how it works and the ways to make sure that they're okay. And they run their businesses in a way where they can get tax-free benefits. I can reimburse 100% of my medical, dental, and vision, for example, out of a C Corp. I could avoid a ton of employment taxes through an S Corp. They understand that an LLC can take either form. They understand that there's something called an accountable plan, where I can reimburse portions of my home that I can't do it as a sole proprietor. But by being an employee of a business, I can. There's all sorts of benefits when you have a business. And I'm just going to kind of go through these. If you're asking for a beating, by the way, like if you want to be a business and get audited and lose, be a sole proprietor, please. 70% of the businesses out there are sole proprietors. And I'm always shaking my head because the last year we had of any stats on their audit rates, which is tough to get the IRS to give them to us. But the last year, I think it was 2019, they were 800% more likely to be audited as a sole proprietor making 100 grand than you were as the partnership or as an S Corp. It was crazy, or as a C Corp. And here's the problem with sole proprietors. They lose. Nobody follows the rules that you're supposed to because some knucklehead says, oh, they have less formalities. No, they don't. From a tax standpoint, it's identical to an S Corp or a C Corp. The only thing you're getting away from when you're a sole proprietor is instead of filing a separate tax return, you're putting a Schedule C on your return, and you're saying, by the way, I'm tracking all my business and personal use of all my, like my cell phone and my car and everything else. No, you're not. They lose 95% of the time in audits. 94 to 95. I'll make it clear because some field audits, they do a little better. They only lose 94% of the time. They lose 94 to 95% of the time when they are audited, and they are audited significantly more than any other business structure. So if you love getting audited and losing, be that sole proprietor. Otherwise, don't. Like, I'm saying that with like a little bit of irony. If you are making very little money, that sole proprietor may be worth it, but any real business, no, don't be a sole proprietor. Make sure that you're doing something else. What's better? Hey, if I'm running a business and I'm living off of that income, I probably want to be an S Corp because I could save myself significant amount of self-employment tax. The reason being is if I'm a sole proprietor, 100% of my net income is subject to Social Security taxes. They call it the self-employment taxes. Old age and disability and survivor's insurance, that's 12.4% and 2.9% for Medicare. You get hit on that. So it's 15.3%. You making 100 grand, you're going to be paying, there's a partial deduction, so it's actually $14,100 on 100 grand. And I could avoid about 70% of that. I could avoid close to $9,000 to $10,000 of that just by being an S Corp. So that's better. That's I'll say that there's good. Better would probably be incorporating a C Corp if you're a high income person, understanding that a C Corp has a flat 21% tax rate. And by the way, that does not expire when the Tax Cut and Jobs Act expires at the end of 2025. That's going on per infinity. The best is usually a combination. So like if I have real estate, I'll probably have that in an LLC. If I have my trading account, it'll probably be in an LLC or a limited partnership. And I'm going to have it managed by a family office that is going to be my business. And I get lots and lots of benefits out of that. Number 8. This is going to trip some of you guys out. Tax-free bonds. Tax-free bonds, muni bonds. I get 5%, but I don't have to pay tax on it. I get 6%, but I don't have to pay tax on it. I get 4%, I don't have to pay tax on it. The rich understand that depending on their tax situation, this might be wise. Those tax-free bonds, if I build up enough of them, then it's not going to push me into higher brackets. When I get Social Security benefits, it's not going to push me up into higher brackets. It's a nice way to have an income stream without the worries of taxes. Now, I have tax-free muni bonds. Some people say, like, Toby, you're an investor. Why are you doing that? It's all about allocation of risk, and it's about being intelligent. If I have money coming in, I have to look and say, what's the tax hit on that money? If I have real estate, hopefully it's zero. But if I have other income, like if I make W-2 wages, if I have other active income, if I have other pieces of businesses that kick down income, I have to be careful. I don't want to be sitting here at 37% just getting slaughtered by the tax, just bam, bam, bam. I don't want that. If you're in New York or California, you could be looking at a 50% tax break or tax rate. So these guys may come in and you say, you know what, I don't need to make 7%. If I can make 5% tax-free, I'm making more money and I'm reducing my risk. So it absolutely plays a spot in most wealthy portfolios. I know that as a fact because I work with a bunch of different financial advisors. And it's kind of that weird undercurrent where nobody wants to admit, hey, do you have tax-free muni bonds? Oh, why aren't you all in Tesla? Right? No, there's a mix. And most of the wealthy I know do have those types of tax-free muni bonds. And there's no reason. They're exempt. We don't have to worry about taxes. So I'm going to do that. And no tax for state or Fed. I'll take that action all day long. Yes, they're very, very secure. Yes, they don't pay tax. So you should say, yes, it probably has a spot in my portfolio too. Even though you might be Mr. Aggressive or Miss Aggressive, it still has a place for you. Number 9, life insurance. Not just any life insurance. The rich understand that you can set up life insurance with cash value and access that cash value absolutely tax-free. How do you do it? Index universal life, some whole life. I'm going to say this though. They understand that you can borrow against the cash value and access the death benefit under certain circumstances tax-free. Now, here's why they do it. Because the insurance proceeds are tax-free. So not only do I have cash value that compounds tax-free, but my benefit, my death benefit, is not taxable either. So a lot of wealthy use life insurance so that they don't have to sell assets when they die. They're really setting it up so that they're looking at it saying, my estate, if it's worth 50 million bucks, I'm going to have a taxable estate. I know that there's a portion of it. Maybe I'll be able to avoid tax on 28 million or whatever the number is. Maybe I'll be able to avoid it, but now that leaves me with 22 million that's going to be taxed at 40% plus my state. I could be higher than 40%. I could be looking at 50% tax it, maybe 45, but let's just call it 40. So I have $22 million at 40%. So that's 8.8 million. So let me get some life insurance so I'm liquid so that my family doesn't have to sell a bunch of real estate. You might not be thinking much of this, but I recall estates that got tied up in probate during 2008 where the value when somebody passed away versus when they were actually able to sell you had reductions in their real estate values of 40, 50, 60%. In some cases, you couldn't even find a buyer. You still had to pay the tax. So the life insurance creates liquidity. The rich understand this. The other thing they understand is life happens. What if I need capital? It's nice to have a cash value. If you understand how these things work, there's the infinite banking system, bank on yourself. All these guys are using it as a ploy to sell you crappy policies. Make sure you have a good insurance policy. I'm not saying they're all bad. I love the concept, but some of them are built for the insurance agent to make a crud ton of money. Others are built to make you money. And then there's guys like Dave Ramsey who just hates them, period, but then lots of his people use them, right? So there's no way around it, right? They have this tax-free advantage of the cash value growing, and you can borrow against it and reinvest that money into other things. So I could borrow, for example, from my policy, and it might be a wash loan. Like, hey, I make nothing on the money that's in there, but I don't have to pay interest. I was making 5 or 6%. Okay, so I have a 5%, 6% loan. Or you just borrow it at whatever the rate is. Maybe it's 5%. Okay, so I have a 5% loan. I go out there and I'm making 10%. I make the spread. Great. Do I have to pay it back? No. All I have to do is die, right? Eventually, it's going to get paid back off of my death benefit, or it's just going to take the cash value and pay it back. And again, depending on the policy. Some policies, you forfeit your cash value, depending on the policy, how it's written when you're done. So you're paying, the death benefit goes to pay it back, and others, they don't. It all depends on who you're working with and how they're writing that policy. So I'd be like making sure you're working with somebody who's a good, probably a fiduciary. I tend to say that. I like people that are CFPs or have a fiduciary license, so they have to put your interest before their own, because the commissions can be pretty high on these things, guys. But they're using life insurance. There's the Rockefellers. There's a lot of folks use them as the example of how they perpetuate their wealth, and it's by using life insurance on various individuals in their family. They always buy it, and then if somebody passes, there's a big chunk of cash that comes in, yada, yada, yada. All those are concepts. I can tell you, as somebody who's in this area and who actually has these policies, the reason that most people are using it is because they get access to cash if they need it. If they don't, they won't. But if they do, they don't have to worry about it getting smashed with taxes. Like if I have to access my retirement account, I might get penalties and I might have tax bill. It's going to cause all my money to get taxed at a higher rate. It sucks, right? If I use a life insurance product, and let's say that I have an incurable illness, I could access my cash value. In some cases, I could access the death benefit. All of it is tax-free. I got that money. I didn't pay tax on it. I pass away. The payback, I don't have to pay tax on that as well. So those life insurance are really great. So number one, I would say that you have tax-free growth on the cash value. That's a huge one. The tax-free proceeds when you pass, and then you can always borrow against it during your lifetime, not have to pay tax on that, and all you have to do is pass away. Number 10, and I'm going to call this tax-efficient funds. So hopefully you guys can read that. Tax-efficient funds. What I'm talking about here is investments that create tax benefits for me. And the main one that I talk about that I see over and over and over again, and there's real estate and things like that that could create some tax loss for you depending on your situation. But the one that works against your W-2 income that absolutely can offset your taxes is oil and gas, doing a working interest in oil and gas. Those are absolutely effective. They're crazy good. And so I would say that the number one that I see people using when they're making $600,000, $700,000 a year and they're in the highest bracket, and they're saying, Jiminy Christmas, I just want to invest and get some of that money back. I don't want to pay tax on $600,000. Could I pay tax on $500,000? It's going to save me $37,000 plus my state. Maybe it's going to save me 50 grand. Yeah, put it in oil and gas. And you're like $100,000 in oil and gas, you might get a $70,000, $80,000 deduction. Put a couple $100,000 in there, it's even more, right? That's a tax-efficient fund. Another type of tax-efficient fund is, let's say you're in the highest bracket again. Rich people end up in that 37%, and they say, Man, I don't want that income hitting me at my ordinary bracket. What other choices are there? Well, there's long-term capital gains, short-term capital gains, which is taxed as ordinary. So you got to get long-term. And there's dividends. Qualified dividends are taxed at that long-term capital gain rate. Well, what's that rate? Depending on your income, it could be zero. If you make less than 90 grand as a married couple, zero. 15% on just about everything else. And if you're in the highest bracket, chances are it's 20%. Now, you do have the Obama era NIT, the net investment income tax, which is 3.8%. So technically, it's 23.8%. That's a lot better than 37%, right? So if I invest in things that are kicking out dividends, I may want to do that. So I have a friend, Kevin Simpson, who does a really great job, Capital Wealth Partners, that does a ETF called DIVO, D-I-V-O. And what are they doing? Covered calls. So there's a little bit of option income, but they're also focusing on dividends. You could do funds like that, or you could focus on your own and say, hey, I want dividend kings. I want dividend aristocrats. I want dividend producing companies. And when they give me that dividend, I know I'm paying tax on it at the long-term capital gain rate, which is way better than my ordinary income. The wealthy understand that there's something called bracketology, right? We want to make sure we're not talking about the NCAA tournament, right? We're talking about looking at your tax bracket, and that tax bracket has a big effect on your net return on your investments. And so the wealthy understand, whoa, there are these tax efficient funds that can make a huge difference. And they use all 10. I just gave you 10. Hey, if you like this type of information, first off, go into the comments and let me know which one of these you've heard of before, which ones you haven't, which one's the most interesting to you. Just so I know, because I could do a deep dive into ones that you guys are really interested in. Let me know in the comments. Number two, if you like this, give me a thumbs up and share it with somebody. It makes a huge difference on the algorithm, and it spreads it out there. And as far as I'm concerned, get that tax knowledge to as many people as humanly possible so they're making intelligent choices. I'm telling you what the rich do. There's no reason we can't do it too.